All right, the sun is in my eyes, but it's time for another video. I'm Zachary Ireland. Welcome to my YouTube channel where I talk about high level and entry level, apparently, real estate concepts. I have gotten a little bit of feedback from clients and others that his content is good, but it's a little bit too complicated, a little bit hard to understand, and I talk a little bit fast. Can't change much about how fast I talk. I mean, if you do want to go into the settings, turn down the watch speed, you can definitely do that, but it's just too hard for me to concentrate on what I'm saying and on how fast I'm saying it. So I'm going to keep doing what I do as far as speed, but I will try and dumb down the content a little bit. And don't take that in an offensive way. It's important to start from the beginning and understand stuff from, a very basic perspective before you try and go above and beyond and start getting into deeper stuff. And that becomes especially apparent when you try and level up. As you obtain more and more rentals, you're going to learn different concepts than when you learned at the beginning. In the beginning, and you can tell what level somebody is at in their real estate journey. As a broker, as a real estate agent, I see this a lot where you can tell how far along somebody is by what problems they're encountering and what things they're concerned with. So today we're going to talk about how much does a real estate investor actually earn and how much can you expect to earn throughout your career. I think right off the bat, it's important to acknowledge that in the beginning, you can expect to earn nothing, at least until, you figure out what you're doing and you get to at least, kind of a higher level. You can expect to earn 0% return. Now, that doesn't mean you won't be earning any money. It just means your money won't be earning anything for you. What do I mean by that? I mean, you might be trading your time for money in the beginning until you establish systems and you team up with other individuals, but your actual investment is going to be very small, and your return on investment, therefore, is also going to be small. So it's a little bit like asking how much wood could a woodchuck chuck if a woodchuck could chuck wood, is how much a real estate investor earns, on their investment. For me, a really cool kind of number that I try and aim for and shoot for in my own investments and for clients is around 25% on the actual money that's invested before appreciation. Now, that might sound, astronomical to those of you who are experienced. That is going to sound astronomical, but I'm talking about beginners here. So if you are buying your first rental and you're in a position and you're where you live, you're able to buy a property you can own or occupy, especially something with multiple units, you should be shooting for about a 25% return on your cash. So whatever you have invested, on the first deal, you should be aiming to get about 25% of that money back on a yearly basis. Now that would be like with 5% down, with 10% down, even 25% down, it's definitely possible to do this. I'll just go through two really quick examples of why you can expect a larger return on investment when you're just a beginner. So the first reason is you're not investing that much money. So when you invest a small sum of money, and investors in all walks will understand this. So in the stock market, it's the same thing. Very, very small companies, generally the turnarounds are much faster and the returns on investment can be very, very quick as well. If you invest in a company with a stock price of only $1, a 50-cent move would be a 50% increase in that stock. And it's the same with, triplexes, duplexes, and even single family houses. It's very favorable to flippers typically. If you're buying something for only like 250 grand, increasing the income, getting a better income out of that and increasing the rents and getting a better return is very easy. So going from $250,000 duplex to a $400,000 duplex in just a few years, you've got an almost 50% return on the building. And as far as your investment, that would be a much larger return because you don't buy a building 100% cash, especially when you're starting out. You buy it on leverage. So let's say the building only appreciates, by 5% from one year to the next. And I'm talking about forced appreciation here, like not natural appreciation, because we can't count on that. It's hard to predict. But if you improve the income and you improve the physical structure of the building such that there's a 5% increase in value just 1 year to the next, if you paid 5% down for the property, that's like a 25, 5 times 5 would be a 25% return on your actual investment. And that's only that would be a 5-to-1 leverage. If you're on 20 to 1 leverage, which is 5 times down, that's a 100% return on investment because you only paid 5% down. It really does work like that. It seems crazy, but if you pay 5% down for a $250,000 building, that's a $15,000 down payment. If you increase the value of the building by 5%, or increase the rents, let's say by 5%, which is very, very small, you've increased the value of the building by $15,000. You've essentially doubled up on your initial investment in just a year. But again, $15,000, it's a lot less than someone earns, in their regular job. It's not big money. And that's kind of what I wanted to explain with the first of these two examples is when you're working with small sums of money, these like large percentage returns don't actually have that much consequence. You're more looking at the dollar amounts, and $15,000, though it would be nice to have, it won't even, really cover your selling expenses if you decide to flip the building. So percentages, one thing, actual numbers in your bank account, different thing. You can't put percentages in your bank account. The second example I would give is with small buildings and owner-occupieds, the reason you can get really good quick returns is because of not loophole, but because of the favorability toward owners to evict tenants should they want to move into the building themselves. So let's say you have a building. One of the units, this happens all the time, one of the units is earning a good, modern, up-to-date rent, good unit. The other unit is old, requires a lot of work. Tenant is paying a very low, old rent, like something from years ago. Which of these two units are you going to move into? Now, if you want to be comfortable, if you want everything to be easy, you move into the good unit, right? Kick out the higher rent-paying tenant. But to a house hacker, someone who's looking to get a good return on investment, maybe get some equity in their property, roll that into the next building, you would want to evict the lower rent-paying tenant and fix up that unit once you move in so that it can appraise higher and you can have equity in your property. So raising the rent by just about $200 per month, which is very achievable in this scenario I just gave. $200 per month, it's $2,400 over the course of a year. You multiply that out by a 7% cap rate, you have almost $35,000 increased value to the building. So imagine, someone's paying $600 for a one-bedroom apartment in Sudbury, should be paying $1,000 per month for that same apartment. That's $400 per month difference. Imagine they're using all the same utilities, water, everything like that. That means net operating income has increased by $4,800 per year. So $4,800 per year divided by the cap rate, which in this case we're going to assume is around 7 because that's the going cap rate in the Sudbury area right now. You've got a $70,000 increase in value just from that one unit. So $70,000, that's more than the average income in Sudbury right now. So if you're working your full-time job, you're able to pull this off, do the improvements, move into the apartment yourself. That's like quite a bit of money just for 1 year and turning over one tenant. The other tenant, assuming that they're paying the market rent, and with the fix-ups that you do to the inside and the outside, it's very likely you'll be able to use the equity from that building, and you won't have to sell the building in order to move to something bigger. You can just refinance, keep the 20% equity. Usually LTV is around 80 to 20 right now, so you can have 80% of it loaned and 20% of it as equity. You only paid 5% down originally, but now you'll have 20% in equity, and you'll be able to take some of that and roll it into next buildings. So those are the two reasons usually that new investors have the advantage. We could do an entire video just about that, but let's go on to point number 2. When you're asking the question of how much return does a real estate investor really get, the question you have to ask is how efficient is their return on a door basis, per square footage basis, or a per unit basis, or a per building basis? Like, there's just so many questions you have to ask. If someone says, I'm earning a $10,000 per month return, if someone says they're earning a $10,000 per month return on investment in their real estate portfolio, that could be a very small building if the building is completely paid off. Maybe they're getting $10,000, that's going to be taxable regular income because they don't have a lot of deductions. So, the building's working efficiently, they have their loans paid off. So $10,000 is pretty achievable just for like one, multiplex, like an 8-plex or a 10-plex, which is very achievable to pay off within somebody's lifetime. 25-year amortization, for example. But the same person, or a similar person in a similar scenario would say, I'm earning a $10,000 per month income so I can quit my job. And you ask them, well, like, what does that mean? $10,000 per month income. And they say, oh, I have 100 units. You divide that by the $10,000. That means they're only earning $100 per unit per month return. Now, does that mean they're earning $10,000 including principal paydown? Probably not, because principal paydown is usually much larger than the actual cash return, usually. In this environment, not so much because interest rates are higher than they have been. But that's the question you have to ask. Is it $10,000 before tax? $10,000, is there tax deductions baked into that $10,000? Because a lot of the time with these cash returns, taxes will be taken out after that. But if you're smart and if you set up your portfolio correctly, and I'm not a tax expert, but I understand the fundamentals, you set it up correctly, your amortization and your write-offs should lower that $10,000 per month income to a number that's, more manageable that you can pay taxes on. The reason I bring up the per door thing is I hear this so often, and it really irks me sometimes when people use this metric as the end all be all. And it really doesn't matter how many doors you have. If they're all, earning a negative return on investment, who cares how many doors you have? And it's the same with dollar amounts. If someone says, I'm earning a $10,000 per month income from my real estate portfolio, that could be as small as just a few houses, if they're set up correctly. And that would be really impressive. But if the same, or similar person owns 100 units, it's really not that impressive because they haven't set it up in an efficient way. And that leaves them really vulnerable to, market fluctuations. And we hear stories about this all the time. If you want to look up Dave Ramsey, now he's kind of a finance guru. But in his previous life, when he was in his 20s, he was a real estate investor. And he kind of leveraged himself too far. When the crash happened in the 80s, he was left out to dry, lost a whole bunch of money. So if you're earning $10,000 per month on like a crazy high leverage ratio, probably not a good idea. If you're earning $10,000 per month and you have no idea what you're doing and you've just kind of fallen into it because of appreciation, it's probably not that great. I would much rather somebody understand what they're doing, have a plan, have built up savings and like a backup account, rather than just kind of going from one building to the next, no idea if they're really profiting, no idea if they're really, doing all the tax deductions they should, because these things can really come back to bite you. So the question you have to ask is when someone says, how much can real estate investors earn? You have to ask over a lifetime, not per year, not per month. It really doesn't matter how much you earn per year or per month. It matters how much you're going to earn over your lifetime. And to quickly, scale back, circle back to what I said earlier, at a 25% return on investment, which is really important to know, what's your return on investment? If the cap rate is, something like 10%, the borrowing rate or the interest rate that you're borrowing at is 5%, there's a 5% spread there. And this is something I harp on a lot, but it's important to understand. That 5% spread is important because increasing leverage will magnify that 5% return. If you're borrowing at 5%, but your building is only earning 3%, then magnifying will actually decrease your returns because you have a negative leverage, if that makes sense. So that negative credit spread is hurting you. The more you borrow, the more money you're having to pay each month for interest. Whereas if you have that building paid off in cash, it's actually performing the best it can because you're losing the least money possible. And again, I don't like to count on appreciation. Years like 2023 are really scary for people who count on appreciation for their returns. This could be a tighten your belt year. Lots of people selling buildings when they weren't planning on it because returns, as far as appreciation and market appreciation, just cannot be counted on to build your wealth. Whereas a credit spread of 5%, leveraged at that clean 80% loan to value, that's a 5 times loan to value ratio. A 25% return would be achievable with only a 5% credit spread. So taking that 5% credit spread, turn it into a 25% return, what would that look like over the course of a lifetime? Well, with a $100,000 initial investment compounded annually, which is, again, if you buy a building every year and you're rolling over every year, that roughly 25% return with that 5% credit spread would turn into about $750 million with a B after just 40 years of investing. So that's the power of compound interest, just to tell you how powerful it is, but it's also the power of magnified returns in a healthy real estate market. And just to let you know, borrowing rates are at around 5% right now, and a 10% net operating income is achievable right now. So the numbers I'm giving you are totally achievable. And 2 years ago, when interest rates were at 1.5% on a 5-year fixed basis, for those of us who kind of assumed that rates were going to increase, locked in for those 5 years, get 5 good years, the credit spreads are much higher. It's not uncommon to see like a 10%, which sounds ridiculous now that, we think of it. But you also have to remember that's not going to be all cash. Some of that is going to be baked into the loan as part of principal reduction. Because when you take a credit spread, it's just the cap rate and the interest rate. It doesn't account for principal pay down. Some people, if they're doing a real cash on cash return, will do, the principal doesn't count as cash. But that's your money to keep. It's not tax deductible. That's an income that you're making. So, why would you not count that as your return? I don't know. But if you assume, and this is kind of unachievable, but if you assume that every year you're going to be rolling your principal and your equity into new investments, into more efficient investments to achieve that 25% return on investment, you can assume that you're going to be very wealthy by the end of your lifetime. Should you always be careful and not lose your initial investment? With only $100,000 down, and that's not a lot of money, just by the way, it's very achievable. The question that you should be asking if you want to get into the real estate investing game is not how much do real estate investors earn, it's how much should they earn. So how much should I be earning as a real estate investor? Look at your portfolio, talk to a professional, consult with me if you want to, and I will break it down for you how much you could be earning or how much you should be earning based on your investments. Because that's a lot more important, is how much you personally could be earning, rather than, what does Dave Ramsey, for example, earn on his real estate investments? We already know. The net operating income tells us everything we need to know. It doesn't matter what their loan is at, because that doesn't affect us, unless it's an assumable mortgage, which is more rare than common. We're going to get our own loans. So why does it matter what they have? What matters is the net operating income. What could the net operating income be if we increased rents, increased efficiency, lowered the expenses, cycled through tenants that are not paying the market rents, maybe moved into a unit ourselves? So that differential is going to tell you, is this building worth my time? Rather than just looking at, strictly in terms of the numbers. And I hear this all the time. What are the numbers? What are the numbers? But they never ask what could the numbers be. And that's just as important, because that spread, in my, experience, that credit spread of about 5% is, it's achievable if you're careful and you're looking for the right buildings. You're not going to find turnkey at 5% credit spreads, but it is possible to do so. So I'm going to wrap this up. Thanks for watching. I'm Zachary Ireland. If you have more questions, put them in the comments below, or send me an email through our website. I'm going to put that in the description. And just get in touch, because it could be fun to consult some new clients. I think 2023 is a great time to buy, not necessarily because it's going to be a huge appreciation. Again, you can never count on appreciation, but it's a lot less competitive than it has been in previous years. Rents still have, they're still increasing every single year. The last year was almost 20% rent increases, which is just crazy compared to market appreciation. Rent increases are really, really high. And could be an interesting next 40 years for you if you decide to take action today. So get in touch with me, like I said, in the description. And that's about it. I'll see you guys in the next video.